Thank you for coming today, everybody. I want to let everyone know that this webinar is being recorded, so please keep yourselves muted unless you want to ask a question. I'll also be managing the chat function as well in case you want to put something in the chat. I want to thank Steve for volunteering to do this workshop for us today. Steve began his insurance and financial career in 1986 with John Hancock and was consistently ranked in the top 5% of the company. He started Fairway Financial in 1999 to serve his clients more objectively and holds his RICP designation from the American College. He is the host of Ready, Set, Retire radio on 95.1 FM WXTK on Saturdays at 6 a.m. And he also routinely conducts live workshops on topics like retirement income and Social Security, and has also written articles for Forbes.com and U.S. News and World Report. He is also the author of the national best-selling book, Tee Up Your Retirement. I will now hand it over to Steve.
Wow, thank you for that introduction. I wasn't expecting that, so that's very nice. I should do these more often, I guess. Hello, everybody, and thanks for coming this morning. And Shano, big shout out to you. Thanks for putting this together. So, like you said, I am Steve Anzoni. I've been in the business a long time. Thank you for that, Jen. Since 86. My gosh. My wife currently today is the one who got me in the business, so it's her fault that I'm still doing this after 38 years. And so it's been great. And I did go independent, like you mentioned, because I wanted to be able to, be a business owner and represent, all the companies in the state. So today we're going to just, and I'm not a huge PowerPoint person, just so you know. When I do my seminars, I just talk and live, but obviously for Zoom meetings, it's good to have some pieces out there. So I thought I'd just, with the help of Kelly in my office, my marketing director, she put this together for me. And we're going to talk about smart tax moves to protect your business. And I just wanted to get into the 4 types of money that are out there. And I talk about this at my workshop too, because there are really only 4 types. And, as business owners, we wear multiple hats. I mean, it's crazy, right? I mean, one day we're trying to do payroll. The next day we're trying to figure out, our retirement or our kids' education. There's always something that seems to pop up with us. And it's just the way it is. But I enjoy it, and it gives me a certain freedom that I think is great. And so I put these pieces together to just try to help people understand the basic concepts of where money is, how it's positioned, and more importantly, how it's taxed, because that's really the ultimate bottom line. So look, the best pile of money is free money, right? I mean, you get an inheritance, you win the lottery, or you get a gift from an uncle or somebody else. I mean, that is obviously the best type of money to get. It doesn't necessarily stay free. I mean, that's the challenge, is what you do with it can determine whether it's taxed in the future or taxed that year. The next type of money is tax-free. All right, that's the next best category. And those are municipal bonds, 401k match. So a lot of people forget that, but your 401k match is tax-free to you because you're not paying it, right? You're getting the match. Afterwards, though, it migrates to a different pile, but initially it's tax-free. A Roth 401k. And for those of you out there who think, well, I'm a small business, I don't know if I'm eligible for that, you are. I mean, if you have a 401k, you are eligible to do what is called a Roth 401k, which means you fund it with after-tax money instead of taxable money, okay? And you put the money in after, and it grows tax-free, okay? So all the money grows tax-free, your principal, your interest, everything, the whole pile. And you can also do that with IRAs too, right? And to determine which one is a better pile, I don't know how to shut that off, but I think I need it on anyway, so we'll deal with it. To determine really what the best pile is, really should talk to your CPA to see where your tax bracket is. But I'm going to tell you right now, we have the lowest tax brackets in the last 30 years. Okay, I'm talking about federal, right? They're the lowest brackets that been. So keep that in mind because they are going to go away at the end of 2025, if not sooner. But I don't think Congress is going to do anything with taxes because obviously it's an election year. And that's the last thing you want to do is to raise taxes during election year. So I think we're going to be safe for a few years. And then the last tax-free category, which people, it blows my mind. They don't know about this, but life insurance cash value can grow tax-free. And you can also take it as a tax-free income. It's an incredible shelter. It's really the last non-qualified shelter. When I say non-qualified, what I mean, it has nothing to do with the government, which can be a really good thing. Okay. So there's no caps on it. There's no rules. There's no, added administrative fees or any of that stuff. You can just do it for yourself and your wife and maybe some key employees. You don't have to include everybody. So that's what makes that really, really valuable. And it's one of the few tax shelters left that is not controlled by the government. So hopefully they leave that alone, but it is in writing. It's actually in the Internal Revenue Code, life insurance. It's one of the few products that's in there. So those are the tax-free categories. And the next category, most of us have the tax deferred, right? The 401k and IRA obviously is part of that pile. But for most of us in the small business world, we probably have what is called a simple IRA or a SEP IRA, which is a super IRA, right? It allows us to put up, to more money than 7,500. Okay. And that's a very popular vehicle that I see small businesses doing. And of course, 401ks, tax deferred means exactly that. The money is deferred until a future point. And so the theory was back in the day that most people would be in a higher tax bracket while they were working. And when they retired, they'd be in a lower tax bracket. But that's not necessarily the case. If you've done a really, really good job saving, you could be in a higher tax bracket when you retire. Because remember, while you're working, you have more tax deductions, including maybe your mortgage, your kids running around the house, right? Those are little deductions. And everything else that we have, available to us as a business owner. When we retire those deductions too. So think about that. Sometimes you're going to be in a higher tax bracket than you think. And in 2 years, we're all going to be in a high tax bracket. And an annuity, by the way, is another non-qualified vehicle that is tax sheltered by its nature. So it doesn't have to be an IRA to be a tax shelter if you own an annuity. So that's another great feature of the annuity. But of course, it is tax deferred. And down the road, you're going to have to pay the taxes on the interest only, not the principal. So that's how that works. And then the thumbs down, I like that, Kelly, is the taxable accounts that we all need, right? We all need to have, our banks, our brokerage accounts. And it's really kind of cool that in the last year, we all actually got these 1099 INTs, from our bank. It's like, wow, we actually earned interest. And it was really cool to see that on return, because a lot of us have to have a business account where money is liquid coming in and out to run our business. And we really weren't able to make anything on that because we needed it liquid. We needed it, available and, in and out and in and out. Today, you can get 4% or maybe slightly more on a money market business account. And that's pretty good for our liquid cash needs in our corporation, because prior to that, obviously, we're earning nothing. So those are basically the four categories out there of money. And money can migrate. So it really can, it can be very tricky if you don't watch it. In other words, a 401k match, like I said before, was tax-free when you got it, but it doesn't stay tax-free, right? It becomes tax deferred, okay, the day after you receive it. An inheritance, right? A lottery can be, it's free to you, obviously, the lottery. The money, you're going to have to pay taxes on it eventually, but it's a free pile of money that you didn't have before. And a gift is free, right? Up to $18,000 per person. However, where you put it after that can end up being in a taxable account. So you got to just figure out what you're going to do with that for the future. So there's really the four types of money. And I know there's a gazillion mutual funds out there and a gazillion types of annuities. And if you ever go online and just click, retirement planning, or you try to educate yourself, you can really go down a rabbit hole. It can be an unbelievably tedious task just to try to get the simplest thing. So as an example, I became a grandfather. Let's see, 2 years ago almost. My grandson's going to be 2 in a few weeks. And so I started investigating 529 plans, which is a way you can save, for your children or grandchildren in a tax-free type of an account, right? And I did it through Fidelity. So I went online to educate myself. Half an hour later, I was more confused than when I started. I mean, it was crazy. And I'm in the business. So it can be really confusing out there is what I'm getting at. Okay, so what this is I have this in my office available to everybody who wants it. Okay, and this is just the 2024 Federal Tax and Benefit Reference Guide. That's all it is. On the left, you see your federal income tax brackets, and you can see how incredibly low they are. So look at the second column down in the federal married filing jointly. Did you know that if you earned an AGI, adjusted gross income, whoops, what did I do? Let me go back. Whoops, sorry. My expertise is showing there. Thank God I'm better at the financial side. So if you earn 94,000 as a married couple, do you realize you're only in the 12% federal bracket? I mean, it's crazy. I mean, as a self-employed person, I think our biggest tax is the Social Security tax. I mean, we get nailed on that twice, right? So it's a crazy low bracket. So I just wanted you to see that. And then across, you see the education plans, what you can do into a 529, all the capital gains rules, gift tax, the traditional IRAs, what you can contribute, the limits. So it's a really cool guide. I take no credit for this, by the way. This is my back room doing all this work for me. And this is the other side of it, showing you the Social Security taxable wage base, the taxability of benefits and how pathetic that is. As a business owner, we pay double on the Social Security. And if you see that, look at this. If you're married, making over $44,000, that's it. 85% of our Social Security income is subject to ordinary income tax. It is the most ridiculous tax that we have to pay. And it's not, by the way, it's not Massachusetts, it's the country. It's really unbelievable because we pay taxes on it going in and we're paying coming out. So it's brutal. But you know what? There's nothing we can do about it. So we just grin and bear it, right? And on the end, if you guys are closer to retirement, this is the table that shows you how much you need to take out for required minimum distribution. It's a really cool, handy piece. And maybe your CPAs have done this for you already. But if they haven't, I have them in the office. If you want them, just give us a buzz and we'll be happy to get it out to you. And that's all that was. This is I've done this for over 30 years, kind of building this model. And I finally put it in a one-piece page, thanks again to Kelly. And we color-coded these things on purpose to give people a guide as to what they should consider when they're looking at tax planning or retirement planning, that sort of thing. And people today are more confused than ever because of how things are. So when you look at let's say you have a brokerage statement with Fidelity, right? They're the big boys out there, or Vanguard or somebody like that. You're going to get a 24-page statement, right? First page is going to have this big circle, right? And it's going to say here, here's the breakdown of your money. And then it's going to list the top 10 holdings that you have. And you're going to sit there and go, okay, I get that. And then every page you turn from there on is an adventure. And it really is complicated. And so I said, listen, let me break this down to what the actual goal is. So my definition of retirement planning is when you have enough income to replace your working check, then officially you can retire. And that is the end game. So everyone listening here, that should be the goal, not just the pile of money, but what it can produce for you, how long it can produce it for you, and the tax advantages or disadvantages, right? So again, thanks to Kelly, we got this chart and we were able to break it down to show people what we mean. And the green bucket on the left is the income side. That is the most important bucket of all this, because if you don't have the income, all this other stuff means nothing, and we got to keep working. It's really that simple. And in this bucket, it's Social Security, it's pensions, it's IRAs, 401ks, again, potentially, depending on how they're positioned. Okay, annuities are a great part of that bucket because it's safe and it's upside only. And by the way, IRAs and 401ks, a lot of those aren't safe. And a lot of people mistake those to be pure income. And they're not necessarily pure income. It's just a nice pile of money, but with no guarantees in a lot of cases. And these are the foundation of retirement planning. Okay, that's the foundation. The next bucket is inflation. And I can finally talk about it because, for the last 5 or 6 years, there was nothing to talk about. And it was really hard for me to try to say to people, look, we got inflation we got to worry about. And they're giving me this look like, what inflation, Steve? All right. And now all of a sudden we got 3 years of it tossed at us in 1 year. And it was so intense that, you look at banks, right, who pretty smart people running these things, right? And insurance companies and all that stuff. Every one of them got fooled by how quickly inflation rose. All right. And this whole world of ours is built on the 10-year treasury, right? Mortgage rates, short-term interest rates, all this stuff is based on the 10-year treasury. And in the last year or so, it rose so quickly from sub 1%. Can you imagine putting your money in a 10-year treasury and getting less than 1% for 10 years? No one in their right mind would do that, right? Well, a year or so ago, banks, they need to invest money somewhere. They have to by charter, right? And so do insurance companies. And these people were buying, $100 million at a time. And they were buying these 10-year treasuries at 2%, 2.25%. And by the end of the year, they were worth 6%, which means $100 million portfolio is worth about 70 million. That's the erosion that happens when you buy them at 2%. So the banks were full too. Okay. So inflation is all about risk and reward. And it's where the majority of our money is held while we're working. It's in usually the investment accounts, right? The index accounts, the growth and income accounts, the growth accounts, the aggressive growth, all these different names that are out there, all these different types of investments. And that's usually what it's in. And it is risk versus reward, right? And you got to deal with the tax complications of it. I mean, if you do a 401k traditional, there's taxability there. If you do a Roth 401k, you pay for it now, but you get it all tax-free later. So there's a trade-off there. Do you want to pay now and have it be free later? So I like to say, you got to pay for the gain with some pain. It's like going to the gym, no pain, no gain. And that's really how you need to look at the Roth situation. And I, as a fan of buckets, I do this myself. I have a 401k Roth bucket and I have a regular 401k bucket. And I'll switch depending on what I foresee as my tax deductions for the year. I'm very on this. Like I talk to my accountant, but I'm in the business. So every quarter I monitor what I think's coming in, what's going out, and what I'm better off doing. So I'm very on it because obviously it's a business I'm in, but I think we all need to be on it because as self-employed people, the buck stops with us and you're the one responsible for it. Whether even if you have a money manager or whatever, you ultimately have to kind of know your game plan. All right. So I think it's really important to know that. Then the emergency bucket, I think it's self-explanatory. We all know about emergency buckets. You don't want any risk there. You want most of it in the bank. I call it just in case money. As you get closer to retirement or in retirement, it's home repairs. I laugh about this at the seminar. I said, this money is also for this. Hey, mom and dad, I'm home. Do you mind if I stay a while? And a while could mean a couple of years, right? With the kids coming back. So we joke about that at the workshop because there's a lot of people who go there who are in there, late 50s, 60s, and 70s, and they know exactly what I'm talking about. So, but that's what the emergency money is for. You need to have it. And at least now we can get rewarded. At least we can earn something on it. So we feel like, okay, it's working for us. And the last bucket is exactly that. I mean, no one in retirement, not a lot of people, have a fun bucket. I mean, what's the point of working your whole life and you're sitting there trying to figure out, can I retire? And if I do, can I stay retired? The biggest challenge that people have when I talk to them over the years, their biggest concern is, am I going to run out of money? And that is a huge concern because most of us, we don't have pensions anymore. And these big companies got rid of the pensions because of the massive cost to have these in place, massive costs. And right now, obviously, the biggest cost to these big companies is insurance, right? Insurance is very costly. So we need a fund bucket for your lifestyle, for your trips, for your grandkids, for your goals and dreams. I mean, this is why we put the time in, right? We put the effort in, and in the end, we're supposed to say, all right, I'm here. Let's do this. Let's travel. Let's, go to wherever we got to go and do what we want to do. And, obviously my goal is to golf every other day. Every day would just kill my back. So a fun bucket is put in place as long as these other buckets are full and they're ready to work for you. I mean, think about this. If you knew the day you retired, how much income you would be guaranteed to have, and it was enough for you to retire, wouldn't that make you feel awesome instead of guessing what I have? And that's what most people do. They have a pile of money and they think maybe, with some speculation that they can retire. And it's not necessarily the case. It's a challenge. And, I've been doing this forever and I'm still, I still am challenged with it. I'm still, new information comes up and I'm always still learning after 38 years. But it's good. It keeps me going, keeps me active. And stuff like this is awesome when it comes up because I can share information with fellow local business owners and hopefully, it can help you get on a good path to what you're trying to do. And speaking of which, as Jen said earlier, I did write a book just before COVID. And ironically, thanks to COVID, it went national and it went bestseller. So it's called Tee Up Your Retirement, right? No shock there. I like golf, but it's a guide. It's not, it doesn't have all the answers, but I think the way I wrote it is I try to write it for regular people to understand. All right. I took out a lot of the industry jargon and all that stuff. I gave some examples of these buckets and how it helped people to stabilize what they had. Right. And as an example, I had someone come in last week and he went to the workshop and he had a decent bucket of money. But his question was, Steve, I think I'm okay. I'm not sure. I mean, I just have Social Security. So we worked it. We ran the numbers. We did some things, and I added a layer of, I think, around $4,000 a month of extra income on top of Social Security. And he was just thrilled to say, I didn't know I can do this. I had no idea that there were vehicles out there that would basically be my own pension that could guarantee myself and my spouse a check for life. And so he was thrilled to learn about it. So there are products like that. And one of the things, we talked about tax-free, right? And obviously tax-free is nice. It sounds even great to say tax-free, right? I mean, it makes us feel good. How would you like to go on vacation? Tax-free. How would you like to, retire? Tax-free. And if you position your money right, you really have an opportunity to retire as close to tax-free as possible. Now, I'm not going to take any credit for this book. My friend wrote it, but we have them in here. And it's called Tax-Free Retirement. And that's pretty sweet. Just the title is pretty good. And Patrick has been in the industry for a very, very long time. He was a financial planner in the industry. And then he just got to writing books and now that's all he does. And it really is a well-written book. And it talks about how to use life insurance. And I know you guys are thinking, and gals are going, what are you talking about, Steve? Life insurance for when I die? No, life insurance can be when you, for living too. You can get a tax-free income for life out of it. You don't even have to wait till you're 59 and a half to draw down the money. I mean, there's no government rules on this. So it's a great source to fund an education plan, right? Along with the 529. It's a great way to do that. It's a great way to add another layer of retirement income planning to your portfolio. And of course, to have the insurance benefit if you don't make it, right? And that comes in tax-free too. So you got tax-free growth, tax-free income, tax-free death benefit. I mean, that's all pretty good. So there are more than, one way to do things. The traditional way for all of us is typically 401ks and IRAs, and they're not terrible. However, there are other ways that you can supplement that may be more beneficial to you. So that's the whole idea behind today. And like I said, I'm not a very lengthy, wordy person, except when I do the seminars, I can go on, right, Kelly? And but I appreciate you guys listening to this morning. And Jen, did you say that there were questions? You could do a Q&A?
Yeah, does anyone have any questions for Steve?
I have one, Steve. Thank you. That was really informative. I was trying to do some reading a week or two ago and try to learn more about this stuff, and I never heard of this until recently. There's apparently a solo 401k, or like a self-employed 401k, that's different than a normal 401k. Do you have any feedback or thoughts?
Yeah, it's not much different. It's just called that because it's obviously intended to market to one or two employee companies, right? I mean, there's a cost that you have to bear for a 401k. I mean, when you do anything involving the government, hello, right? They make you include all your, I think it's 21-hour plus employees, right?
Okay.
So that's one of the caveats to that. And, if you don't mind doing that, or if you can, that's great. There's also something in there called NEC. It's a non-elective contribution that you have to make as an employer on behalf of your employees, because typically the employer is the higher paid person. And so the 401k by its very nature doesn't want the big boss, if you will, to benefit more than the employees. So they have this NEC they put in there. So it can be complicated, but the solo it's just a marketing name mostly. It's
Gotcha.
Still a 401k. They kind of strip it down a little bit, have a little less options for retirement, but it's a good deal. And you got to keep the costs down, Shane, because these can get administratively expensive. And that's why if you weigh it out and you figure out how much am I going to put in,
Mm-hmm.
If it's say less than 20 grand or something like that, you might be better off doing what is called a simple IRA. And that's in that tax sheet here that I said everyone can have. There's rules in there about how you can do those, the amounts that you can contribute. It's really cool. So you could do that. And Fidelity and Vanguard, they're awesome. You can just go on there and click simple. You gotta know what you want before you go on there. Like I said, or you could just be a lost puppy there.
Yeah.
But if you click on simple, they'll tell you, what the contribution is, how you can set it up. It's pretty easy to set up. And with a simple IRA, you don't have to include everybody. So
Okay.
that's the benefit. But you're right, there is solo 401k, and it's designed for the small 1 or 2 person shop. Yep.
Cool.
Yep. It's that marketing in our industry, right? It's all about the name. So yeah, but this has been great. I hope some of that information is helpful to you guys. I have copies of those books. I am happy to give you copies of Patrick's book. I mean, I think it's a fascinating read to read how you can save tax-free for yourself, for your family, how you can grow this estate with pennies on the dollar. It's really cool. And you should know about it. We all should know about this. I'm sorry, go ahead, someone. Oh, I thought I heard someone jump in there. We good? We all set?
Does anybody else have any other questions? that is a no.
Thank you, Steve. This is great.
Thank
I
you,
appreciate
Steve.
it.
I
Well,
appreciate
no
you.
problem. I'm right here in Hyannis, right down the street. And, stop by, pick up a book. My staff is here, I'm here, and we'd be happy to share information because that's what this is all about, is small businesses helping small businesses get to where we need to be. So I appreciate it, everybody. Have a great day, and thank you for listening.
Thank you, Steve.